Hey, everybody. I hope you're having an awesome day. So we got some action today, S&P pushing a lot higher. I wanted to look at Netflix. What an incredible move we had from this particular stock. So, of course, this is a name that I've loved for a very long time. Here I am on TD Ameritrade with Oliver Rennick talking about Netflix and Costco. Netflix was $225 at the time. So here it is at almost $1,000. And it's just been one of my favorite stocks. We're going to talk a little bit in depth about it here. What a massive move. Look at this. They got this wrong, sold it off from these incredible highs that we saw. And then we'll talk about how we put on our cash machine trade down here. And we put on another one this morning. And I'm going to explain what we did there. So we're going to do a little bit of Netflix and review. What do we like about it? Because of course, all roads lead back to the stock when you're trading options. You need to be very quick reminder that we are not investment advisors and that anything we talk about today should not be construed as investment advice of any kind. It is for education, entertainment, and information purposes only. Please do not proceed if you are not in agreement with these conditions. With that underlying and have a good idea of strength, of its underlying fundamental strength, where it could be going. So cash machine trade into the earnings. We'll talk about that. We'll talk about what the play was this morning in terms of reacting to that. And we'll figure out where the dollars were and where they are now. So let's get right into it. So Netflix really hit it out of the park. This was very unexpected. Their ad plan is absolutely killing it. That was a big turning point a couple of years ago when they announced that. And of course, everything we see, ads are a deal with Meta, with Amazon, et cetera. These are big needle movers for these companies now, and they know that, and they're pushing into it. So 55% of signups in the recent quarter were into the ad plan, right? That plan where you pay a little bit less, but you've got to watch some ads. It's no big deal. We've got that one. No big deal. You look at an ad, but this is gold for companies out there that want to advertise on Netflix, which is an incredible behemoth. So lots of revenue from the ad tier. And big thing that they're adding here, they're now allowing an extra member to be added to the ads plan for a few bucks. So they are very aware that these eyeballs are the key. They're focusing on as many as they can get. Whereas before, in years past, it was just all about, getting those subscribers, that subscriber revenue. Now they've got this extra revenue stream and they're loving it. So it's all about ads. They doubled their revenue from ads year over year, and they're probably going to double them again next year. So let's keep looking into this. 19 million subscribers added. That's 10 million more than expected. The question, of course, is, was Tyson a part of that? Did people, of course, they probably had a lot of people sign up for that Tyson fight. But then a lot of them stayed on for Squid Game, and it remains to be seen how many end up dropping. The next quarter is actually going to be kind of interesting to see if there was that sort of initial push and then a drop after that. But so far, the market isn't too concerned about that. They've been raising prices, so they announced a price raise. Can they raise more, right? So this is a big question out there. Can they raise more? When they did this years ago, this was a problem. The market didn't like it. They sold the stock off. And they figured that was going to be a headwind for the company. Why is it okay to do now? Well, because Netflix is by far the leader in this space. As I've been talking about this for a couple of years now, saying there is only second place to Netflix. And the interesting thing about that is, I think they retain. Think about it. If you get rid of your Netflix, your family's going to kill you, right? So they have this incredible pricing power. They're raising prices a buck or two depending on the tier. They could raise them $5 or $10. So the nice thing is they actually still have pricing power because nobody is getting rid of Netflix. So let's dig into that a little bit more. Some people are saying, well, what about inflation? Is that going to hurt Netflix? I think Netflix is actually quite insulated because it's entertainment of last resort, right? Let's say you start going out to dinners less. Let's say you start going to fewer sporting events or concerts. What are you going to do? You're going to watch them on Netflix. When all else fails, you have got this sort of step down effect. People can always sit at home and watch Netflix. It is one of the cheapest forms of entertainment out there. You can almost think of it as like a McDonald's, you know, people downgrading from an expensive middle tier restaurant. There's always McDonald's, and McDonald's has some pricing power because of that. When you're sort of down at a very reasonable cost for people, you can you have that little bit of pricing power. Of course, there's some limitation to that. You get prices up to a certain point and people will revolt a little bit, but I think there is a big open area there where they can continue to take advantage of their pricing. So, and furthermore, we're going to see the lemmings, all the analysts out there, they're going to start upgrading this over and over and over again. We're going to see some nice headline risk from that perspective. Remember, headline risk, people following along, analysts following along. As people pile on, this is going to be further fodder for hopefully some support and some further upside to this. So 14 billion in 2025 EBITDA, and that's the expectation out there. At this point, they're going to be raising those numbers, right? So probably 15 to 16 billion in EBITDA. That's 26, 27 times with more pricing power. That's not expensive. They've got more pricing power, in my view. They've got more market share to grab around the world. They said they're about 10% of viewing in many countries. That is a big total addressable market that still has a lot of meat on the bone. They can get in there and continue to grab those subscribers. They have a massive moat. They have an incredible brand. They continue to have pricing power, cash flow, unbelievable. These hikes are pretty much mostly cash flow incremental, right? This is just all margin, 22% margin on this thing. They are in the driver's seat when it comes to streaming. No one else really even comes very close, in my opinion. When people produce content, they want to be on Netflix. It is just hoovering in all the positive things surrounding that streaming business. So let's take a look here and talk about what we had. So January 17th with Netflix at 860, this is in our cash machine bucket. So in our community, we have a number of different kinds of trading areas, different trades that we do. We've got cash secured puts, we've got covered calls, we've got verticals, we've got all kinds of things. We've got, some long option strategies, we've got condors, et cetera, et cetera. So January 17th, I like Netflix. I only do cash machine on stocks that I really, really like and I'm comfortable with. That doesn't mean they can't go down, but I need to be able to be comfortable with owning this particular company. And really, that's kind of the fundamental basis for most of the programs that I teach, is really all roads lead back to the stock, right? That's incredibly important, no matter what strategy you're talking about, particularly in those more traditional option selling strategies. So we sold Netflix at 860, we sold the Feb 800 call at $82. Now, what does that give you? That gives you about $22 of time value, right? The way you figure this out is 860 minus the 82 that you receive for that Feb 800 call equals 778. You take that off of the strike price, and that leaves you with $22 of time value, right? That's going to give you some nice juicy time value, especially if you were to look at the 800 put at that point, you're getting quite a bit less than that because this is building in some cost of carry. So that's a conversation for another day, but you're going to get a little bit more of that nice time value, that extrinsic value out of the calls, generally speaking, especially when rates are higher. So we got in there, grabbed our $22 of time value. What does that mean? Well, we've got protection down to around 778. Below that, you're long Netflix, right? You're long Netflix, you're short this call. The call can only give you so much protection. But the nice thing about doing this cash machine trade is you get a big fat chunk of intrinsic value to give you a little bit of an extra hedge, a lot more of a hedge in addition to that $22 of time value. So what happens today? We jump to $980. What does that mean? Well, you're losing money on your short call, but you're making tons of money on your long stock. And what ends up happening is the time value drains out of that because it's basically representing a synthetic put, which is not worth very much now that we're $180 in the money. And that time value drains to very, very little. So what do we do? Well, I want to get in here because I love the story. I feel like I want to get some extra value out of this. And I think it could be running past $1,000. It's going to have a little, movement in between. There's no question it's an expensive stock, very much in play, but I think it generally kind of is going to march higher. I'm hopeful that that's the case. No guarantees. So with Netflix at 980, I bought that Feb 800 back for 183.50. Now, that was capturing what I talked about earlier. That's a compression of time value in there. With the stock at 980, you're basically grabbing 18.50 in time value, right? So I paid $3.50 of time value, whereas before I received $22 of time value. So I made the difference between those two, and I rolled into a March 950 call for $65 with the stock at 979.80. So what that means is if you do the same calculation you did up here and you go 979.80 minus that $65 difference, that get the difference between that and the strike, and what you're ending up with is $35.20 in time value. Now this is a little bit of a longer play, 58 days as opposed to the original, which wasn't very long. And I'm positioning myself in March. So this is my value, right? This is my new extrinsic time value that I'm trying to benefit from as it hopefully compresses. And one of the reasons I like it is that I think implied volatility in March has a little ways to go down. So we've got, obviously we see a big crush as is customary after earnings. You're going to see this crush almost always, unless you get some unbelievably massive move in a stock after earnings, then it may hang in there a little bit. But right here, we can see a lot of the uncertainty is out of the picture. They're crushing it. I think it has a little bit more room to come down here. What we call that, when you're short options, you have Vega exposure. If you have at least a decent amount of time left, you're not going to have Vega on much Vega on a 1 or 2 day option. But when you're talking 58 days, we definitely have some Vega exposure. So I'm hoping to grab a bit of that Vega exposure as implied volatility comes down a little more. And I think this stock is just going to more or less kind of hang around in here. Does it close this gap? Not impossible, but I'm protected down to about 915 with the total value that I extracted from this call that I sold, right? So you get the intrinsic value plus you get the time value, which has me protected down to 915, which just so happens to be the closing of this gap. So that's another reason I like it. We could almost draw a little line going across here as well that gives us support down around that 910, 915. No guarantees on anything. This broader market could do anything. I think it's generally stable. I don't mind the broader market. So, that just emboldens me a little bit more on this play. But this is a company that is in play. I think there's a fair bit of FOMO out there for it, even after going up whatever it is, 400% over the last couple of years. This is still something people can bet on, good times or bad times. So I hope you guys enjoyed that. That's my cash machine trade. We'll hopefully see that come in. Vega can be quick, right? So when you see that compression of volatility, you get that nice big, that nice quick hit from Vega. Then it's a matter of figuring out, well, do I want to still stay in this thing? My answer would be probably yes. And then that's when theta kicks in. So this is, you have to understand where the torque is coming from in your options plays. Is it from Vega? Is it from theta? And as we transition to theta after that initial Vega drop, we're going to then have the sort of, waiting for basically time to pass for that theta to play out over time. You cannot rush theta. It is what it is. It just takes as long as it takes for that compression to happen as you ride down the decay curve towards expiry. So hopefully that was informative, guys, and we'll see you guys in the next video.